optimistic about a trade deal and about the economy in general because of consumer spending?
Well, it's good to remind oneself what the underlying fundamental drivers of this economy are. Trade, as important as it is and as many headlines as it engenders, is 3 or 4% of GDP. Personal consumption, closer to 70% of GDP. And as long as the labor market is strong, wages are okay, we're in a non-inflationary environment, the consumer keeps spending. We see that from microeconomic data. We see it from macroeconomic data. So I think the trade, if I can use an appropriate late summer metaphor, the trade disputes are like waves crashing on the shore. But the economic tide driven by personal consumption is still coming in.
And not too many sharks in the water, sounds like, Mark, and that would be good for Netflix, no?
Yeah, the one shark, though, are regulators, and there seem to be more of them in the water, to work this analogy. So let me switch over to Netflix. I think of the kind of the large cap kind of internet companies, the most dislocated one now is Netflix. You blow a quarter, i.e. you miss sub numbers, that'll cause your stock to be dislocated. And then you've got these new competitive entrants, Disney and Apple coming up. That's going to cause the stock to be dislocated, too. Partly for those reasons, this is our favorite large cap name. We just published a report over the weekend or yesterday with some new survey data. This is the strongest content slate the company has ever launched. It's coming out in the back half of this year, and specifically in this September quarter. We think that can lead to a real nice pop in subscribers. They need to have record high sub ads the next 2 quarters to meet their goal of accelerating subs. We think this content slate will enable it. We like the stock here, especially at $300.
Mark, I'm curious, why do you think Netflix has underperformed the other FANG names year to date? Because it has been the name out of those 5 big tech companies that we so closely follow that has been the least exposed to regulatory and antitrust scrutiny.
You're right. It's got the least regulatory risk. I think the one, maybe the clearest reason is its valuation is most tenuous. I mean, it's got negative free cash flow. It's not generating $20 billion in cash flow like Facebook or Google. It's generating negative $3.5 billion in cash flow. So the valuation support isn't there as much. They did have a clear miss in terms of sub numbers, the single most important metric that all investors focus on in the June quarter, and this big competitor coming up in the back half of the year. There's no big competitor coming up for Google or Facebook or Amazon. So I think that explains why Netflix has underperformed. It also helps explain why it can start outperforming if those sub numbers come in better, despite the Disney and Apple headwinds. It probably proves something, that this business model and the value proposition is more enduring than we all think. And I just want to try to get one simple point across. What's happening is the breakup of the big cable bundle, and people are going a la carte. And survey work that we do shows that 66% or 2/3 of consumers are willing to sign up for more than one streaming service. We think they will. Netflix is going to be one of those. And what the other one is hard to know. Probably Disney, but there could be other players in there. But Netflix is still going to be in that bundle.
So Netflix has underperformed, but for the month of August, Scott, all the FANG names are down. And when you have such a large market cap group, that represents such a big chunk of the market and has led the entire bull market over the last 10 years, stop going up?
Right.
Can you still have conviction that the market could go up?
I think you can. I actually, as a stock picker, I welcome a broader market leadership. Markets that are very narrowly led tend to be fragile. We saw that late last year, where the market sell-off, led by these FANG names. So as an individual stock picker, I prefer a broader market, and I prefer a wider choice of companies that aren't necessarily moving in tandem with each other.
But you don't see it as a risk-off move?
No, I don't.
Mark, I want to get back to something that you mentioned with Netflix when it comes to the sub ads needed. How many of those need to be domestic? Because we talk about Netflix as if everybody's got it. But if you're not a Netflix subscriber at this point, with Apple and Disney coming out, are you really going to sign up?
Yeah, so Netflix has gone global over the last couple of years. And what I mean by that is it's now over 85% of all of their new subscribers are coming from outside of the U.S. They have approximately 60 million in the U.S. We think that number can get to 70, 75 million, maybe 80 million. But, you're clearly sixth inning or something like that into the Netflix growth in the U.S. market. They used to be able to consistently add 5 million subscribers a year. We think that number is going to be more like 4 million, going down to 3 million over the next couple of years. There's no question that they've got a very strong position in the U.S. Growth is fading for them. It all depends on the international markets. That's really where the growth is for Netflix now.
So, Scott, to go back to the point you just made, looking beyond FANG, what do you like in the market right now?
Morgan, I like companies that are exposed to this underlying strength of personal consumption that I referred to. So both in the consumer staples, sort of old-fashioned dividend-yielding stocks are nice, and also in the discretionary space, because I think the consumer is fine. We've seen that for the past couple of years, despite the litany of concerns about the economy, the litany of tariff rounds. When the going gets tough, people go shopping, and that's been the case, and I think it'll continue to be the case.